Thank you, Janesh, for your kind introduction, and thank you, Anand bhai. And last but not the least, thank you, students, for coming in such a large number on a holiday weekend on a Friday. This topic is not very interesting as you would like in a weekend day, but weekend and holiday, but it is nonetheless very important topic. So, Nidhi, I'm very confident that Nidhi will sail us through this topic. So, if whenever you have any questions, no, you can type in Q&A. Okay, if it is relevant to the current topic or current point which we are discussing, then we may take as it varies basis, and if it may come on later stages, that point will come in next slide or something like that, then we will come at that point of time. Okay, so in between, if I require, I may interrupt, and otherwise Nidhi will guide us in this entire proceeding. Over to you, Nidhi.
Thank you, Vijay sir. Before we can begin, I'll just start to share my screen. Good evening, everyone. So, whenever we say Schedule 3, the first thing that comes to our mind is financials. Now, each and every one of us have started to prepare financials right since our 12th standard, I would say. And then we went to a CA Inter when we got to know, okay, so there's some specific format in which we would have to be making them. We did learn certain disclosures in CA Inter from our AS that we had learned. But when we look at the financials of actual companies, we get to know that there are things which are much beyond what we had studied in our books, right? So today's session is basically to take you beyond your books. To start with, from the background of Schedule 3, now to which entities is Schedule 3 applicable? So Schedule 3 is now it is prescribed by Companies Act. So it is not quite evident. Okay, it is applicable for the companies. So what about other entities? For other entities, there is no prescribed format as such, but our institute has given us certain guidelines which can be accessed from their website. Now, coming back to Schedule 3. Now, Schedule 3 prescribes format for balance sheet, PL, that is your profit and loss account, then statement of changes in equity. Now, this statement of changes in equity is basically for the India's companies. Then you have a certain minimum disclosure, and it also gives us certain guidelines as to how you are supposed to prepare the financials. Now, there were certain amendments in Schedule 3 in the last year. So, by notification dated 24th March 2021, these amendments were announced. And these are applicable for all the financial statements starting from 1st of April 21. So if the company was, say, following a calendar year and the year was 2021, so Jan 21 to December 21. So for these companies, the amendments were not applicable. So any financial statement starting on or after 1st of April 21, the amendments are going to be applicable. Let us move ahead with it. Now, Schedule 3 comes in 3 divisions. That is Division 1, 2, and 3. In case of companies which follow AS, okay, whether it is an NBFC or other than NBFC, you will have to follow Division 1 for it. So let us just glance through it. I'll keep scrolling a little and you all can glance through it. We will get into the details in further parts of our presentation. As and when required, we might come back to those Excel sheets in case we just need to refer to them. Now, for the companies which follow Ind AS, if the company is an NBFC, then it will have to follow Division 3. And if it is other than NBFC company, then it will have to follow division 2. So we also have a format for division 2 financials ready here. So as you all can see here, the assets have come first, and in division 1, we had liabilities before assets. We move to the PL.
Let me answer this. There is one question, Nidhi. So someone is asking what is the difference between, Ashmit is asking division 1 and division 2. So division 1 is a format of financial statement where Ind AS is not applicable. AS companies, whether NBFC or non-NBFC, and division 2 is for Ind AS companies which are not NBFCs. Okay, what is the difference? So difference we will covered in upcoming slides, but major difference is that Ind AS gives one bifurcation apart from current and non-current. Current and non-current bifurcation of assets and liability is there in both AS as well as Ind AS. But in case of Ind AS, there is one additional bifurcation, whether any particular asset is a financial asset or non-financial asset. So in every current asset and non-current asset, we need to give that breakup, whether any financial assets or non-financial asset. Apart from that, as Nidhi said, that first asset appears in this Ind AS financial statement, then liability. Then there is one more component is also involved, statement of changes in equity, which is not there in AS. Okay, and this some of the difference will be covered in upcoming slide, as and when we see.
Okay, so as we discussed in the previous slide, that there will be certain entities to whom division 2 and division 3 will be applicable, and those are the entities to whom Ind AS is applicable. So now let's see to which entities is Ind AS applicable. Firstly, it's listed entities, then the companies with net worth of more than 250 crores, and any company who would voluntarily want to apply Ind AS standards, they can do so. Now, the companies covered in 3 above, if they have any holding subsidiaries, associates, or JVs, then even these companies, that is the holding subsidiary of JV of the 3 above, will also have to apply Ind AS. And as discussed earlier, the NBFCs will have to follow division 3 and non-NBFC companies will have to follow division 2. Now, before we jump into much details of the respective heads of the balance sheet and PL, we should first understand what is current and non-current, as Schedule 3 requires us to bifurcate the assets as well as the liabilities as current and non-current. Therefore, being able to identify what is current and non-current is quite significant. So,
Nidhi, you can flash.
So as you all can see, right now I have opened the Schedule 3 Division 2 balance sheet, and in the assets portion, we are having non-current assets here, that is in column 9, and then we are having current assets. And the same applies to the liabilities portion, that first we would be having non-current liabilities, and followed by it will be the current liabilities. So how to bifurcate between the same? So first of all, if you need to know what is the operating cycle, which will be covered in the later part. So if it is expected to be settled during the operating cycle, then if it is held for trading. Now, example for a held for trading liability is that if a financial asset is borrowed for short trading. So that is one of the examples for held for trading liability. Then if it is expected to be settled within 10 months from the end of your balance, from the end of the year. Here, reporting date means your balance sheet date, normally 31st of March. Then the company should not have any unconditional right to defer the settlement. That means the company does not have any option to select to settle it after 12 months. Then we are having the bifurcation for assets. Now the assets which are expected to be realized within 12 months are normally considered in current assets. Then they should be held for trading. Now when we say held for trading, I can give the example of inventories. Next, we have that it can be a cash or cash equivalent as well. Here we have mentioned in brackets that unless repatriation restrictions are there for 12 months or more. So cash and cash equivalent itself means that the underlying asset is liquid asset. So if you're having repatriation restrictions, that is you're having restrictions on transfer of this cash, then it will not form a part of cash and cash equivalents and ultimately not form a part of the current assets. Now, we came across the term operating cycle while bifurcating in current and non-current, that if it is expected to be settled within the operating cycle, it is current. Now, what is operating cycle? Operating cycle is basically the time between, from the time you acquire some asset and you're able to realize that asset in cash. Generally, we use that operating cycle is equal to trade receivables plus inventory days minus trade payables. Now, trade payable days, because even our creditors give us some time to pay. Even we give some time to our debtors to be paying back, to be paying for the sales that we have done. So this entire period falls under the operating cycle. Now, I have two questions for you. The first one being, can an entity have more than one operating cycle? I would like you all to please answer as yes or no in the chat box.
So most of them are telling yes, all of them actually. Those who have replied have told yes. So correct, Nidhi. They can have more than one operating cycle, right?
Yes, sir. We can have more than one operating cycles when the businesses are quite big. So for different products that they have, we can have different operating cycles as well. Now, can an operating cycle be greater than 12 months? Yes or no?
Yes.
Okay, so as you all have said that the operating cycle can be greater than 12 months, then for the purpose of bifurcating between current and non-current, we normally take 12 months if the operating cycle is less than 12 months. Say it is 5 months, then we are supposed to follow a 12 months for bifurcation. If it is more than 12 months, then you can take, say it is 14 months, then you will have to consider 14 months for bifurcation into current and non-current. So we are starting with the items in our balance sheet. So first comes our share capital. So here are generally the disclosures required when we having share capital. That is the authorized share capital, number of shares issued, paid up, par value of each share, that is your face value, rights, preferences, and restrictions attached to each class of share. For some shares might have different, say, voting rights, or there will be some redemption rights. So these are considered in rights, preference, and restrictions point. Then we have that if a company is held by its holding, or it is having major share, the holding company is having a major share in the company, then we got to specify the shareholding of the same, including the ultimate holding company. Then we also have to mention the shareholding of all the shareholders having more than 5% of the shares. Then in the last 5 years, if the company has done any bonus issue, or if the company has bought back any shares, or if any shares were issued for consideration other than cash, then the same also needs to be disclosed. Then we have terms for any securities. For example, the percentage of preference dividend that you would be giving, the duration after which it would be redeemed. Then next we have is uncalled shares, forfeited shares, and the new requirement as per the amendment which came last year, we will be having the promoters shareholding disclosed. Now let us look at the promoter shareholding in detail. So here's the format. Here's the format in which the shareholding details can be provided. This is given by the notification itself, that you will be having name of the promoter, the number of shares the promoter is holding, percentage of the total share, and change during the year. So now, while calculating change during the year, you will take the opening shareholding as base and then calculate the change in percentage.
One more, please. So, can audience answer from where we will get these details if you are auditing an entity? Okay, so how will you go to get those details? Hello. So I was audible, I was not audible in between, right? So MO is there, you are correct. MO is also there. But suppose MO is prepared at the incorporation or at the time of incorporation. So important thing is to check minutes, board minutes and members meeting of board, minutes of board meeting and minutes of members meeting. Okay, and forms filed with ROC, that we need to check if there are any new issues during the year, new capital issues or redemption of preference shares, some private equity has come during the year, then you at the time of audit, we should check minutes of the various meeting of the companies, and then from there we can get the details. MCA is basically public data. So whatever we audit or whatever the company has to declare, no, that is filed on MCA website, on ROC website. So that is for third party. We being auditor, we have access to internal records. So MCA, of course, it is important, but first of all, we should check internal records of the company. Yes, Nidhi, you can continue.
Thank you, sir. Now let's go ahead with reserves and surplus. Normally, reserves and surplus is classified in the heads that can be seen on the screen. That is our capital reserve, CRR, securities premium, DRR, revaluation reserve, and of course our P&L, which is called as surplus. Now, it is a good practice to have a reconciliation between the opening and closing balances of these reserves, so that the shareholders get to know the movement. Now, if there is any reserve which is specifically earmarked, that means the funds can be used only for the mentioned purpose and no other purpose, then it is called a fund. You cannot be calling it as a reserve, as you cannot utilize it as you want. Then even the negative balances in this reserve, in any of the reserve, will be categorized under reserves and surplus only. It cannot be taken to the asset side, as the clear picture would not be seen, or the clear picture would not be seen looking at the reserves and surplus category only. Now, coming to share application money pending allotment. So as everyone is aware, when a company comes out with comes out with issue, it collects the money from the shareholders, but maybe the shares are not yet allotted. So for normally we have been just showing one line in the Schedule 3, that share application money pending allotment with the amount. But that's not enough. We also need to mention the terms and conditions, the number of shares that are going to be issued against this money, the issue price and the premium. So you will be mentioning the face value and the amount of securities premium that would be coming from it. Next we have is long-term borrowings. Now long-term borrowings is broadly classified in the first thing that is shown on the screen. The first, I would say, the first part. You all can glance through it before we can go ahead with the further classifications of it. So while after classifying the long-term borrowings, we also need to ensure that there are certain disclosures that we got to be giving. That is whether the long-term borrowings that we have taken are secured or unsecured. And if they are secured, then we also need to mention the nature of security, like whether it is hypothecation, pledge. Then if we have received a guarantee for that loan, the same needs to be disclosed as well. The rate of interest, then the maturity in descending order. Then we will be also required to mention the terms of repayment. Also, if there is, as on the balance sheet date, if you have defaulted in payment of any long-term borrowing, the same also needs to be mentioned. Coming to short-term borrowings, now the disclosure requirements are in line with the disclosure requirements for long-term borrowings only. For the classification, you all can glance through it. Also, the current maturities of long-term debt, which was earlier not classified here, it was classified in other current liabilities, which is now classified in short-term borrowings, as you can see in the E point. Next, coming to PPE, that is property, plant and equipment. On screen, I have just taken an extract of how a PPE schedule should look. That is, it normally it forms a part of notes to accounts. So we have the opening for gross block, then we have it for the accumulated depreciation, and it ends with your net carrying value. So this is just a suggested way of having the schedule. Okay. Now for PPA and intangibles, there are certain disclosures required. One of which is that if you've had any revaluation during the year, and if the change due to revaluation is more than 10%. Now the 10% is of the net carrying value, that is your WDV. So if the change is more than 10%, you got to disclose that. Also, if it was done by the registered valuer, the details of the same should also be disclosed. Now, coming to the title deeds of immovable property. Now, if the company is having any immovable property which is not held in name of the company, then we have a schedule in which you are supposed to disclose the details of that property. You are supposed to disclose the gross carrying value, then in whose name are the title deeds actually held, the reason for which you are not holding it in the company's name, and the time since which the property is with the company. Now, there are certain exceptions to the point we discussed right now, that relating to the title deeds. That is, if a company has taken an asset on lease, then it is quite evident that the company is not going to have the rights over that, not going to have the legal rights over that asset with respect to title deeds. And then if a asset is jointly owned, then you are supposed to disclose the details of joint ownership. Now, disclosures pertaining to Benami property. Now, Benami property is basically a property transferred to one party for consideration received from some other party. So if company is having any such property, then the details are supposed to be disclosed in the financials.
So Benami property is actually such kind of property where legal owner and beneficial owner are two different persons. Okay, so that is Benami property. So no company सामने से says कि yes, I am holding Benami property or someone is holding Benami property on my behalf. So where any proceeding have been initiated, at that time only this disclosure is need to be given. Otherwise, no company, well, no one says that yeah, this property in my balance sheet is Benami property, or there is one property which is not in my balance sheet, but I am the beneficial owner of that property. So whenever then proceeding has been initiated or pending against the company, then these disclosures are required.
Okay, so the details which are required are as on the screen, that you will have to mention the year of acquisition, then the cost of that property or the value of that property, then who are the beneficiaries. Then if the property is not recorded in the books, then we need to state the reasons why it is not recorded. And if it is recorded, then you will have to give reference as to where it is recorded. Then this clause is not only applicable when the company is holding any such property, it is also applicable when a company is a party to a Benami property transaction. Moving further, let us come to disclosures which are pertaining to a CWIP, that is a capital work in progress, and intangible assets under development. For this, the capital work in progress will have we will have to give aging for it project wise, and also we will have to mention if there are any projects which are temporarily suspended, then the same needs to be disclosed separately. Again, when we say temporarily suspended, the cases wherein stopping the work on that asset is required for actual development of the asset will not fall under temporary suspension. Then if there are any capital assets which are under progress, but the cost has overshooted, or the duration required to complete the asset has been has not been complied with, so there's a delay in completion, then these assets will have to be disclosed separately project wise, and the time in which you are expecting for those assets to get completed needs to be disclosed. For you can have a look at the two schedules which are on the screen before we go ahead.
So one important thing here is this disclosure requirement is regarding CWIP and intangible asset under development. So if it is a company's inventory, say for example, a real estate company. So for real estate company, if it is developing a building or a residential complex or commercial complex, then this is not capital work in progress, and this detail is not required in company's inventory or say project work in progress. Okay, and another important thing is part B. Part B is like it is factual, so it is management estimate, correct? So if some certain project is stalled, and now it is management estimate when it will get completed. There are many estimates in that. There are many managements belief or some data may be required. So this we have to be very skeptical when if say, and this detail is required for only for those projects whose completion is overdue, not for every capital work in progress. Okay, so if it is completion is overdue, then you need to give this required when it will get completed in future. X saal mein hoga, 2 years or 3 years or more than 3 years. That you need to that the company need to disclose. And auditor, we have to be careful. Otherwise, if we are not able to satisfy ourselves from the management estimate, and then we may have to report appropriately in our audit report. Okay, because this is you cannot verify what will happen in future. Okay, at what point of time the certain project will get completed. So take this as a pinch of salt, this disclosure. Yes, Nidhi.
Okay. Moving ahead with long-term loans and advances, which are broadly classified in capital advances, loans and advances to related parties, and other loans and advances. Now, even these are to be classified in secured and unsecured. And if there are any loans that you are not expecting to be receiving back, that is the doubtful category loans, then you are supposed to make an allowance for the same. Now, this allowance will also be a part of long-term loans and advances only. It will not be shown elsewhere. Also, if the company has given any loans to its officers, directors of the company, or persons related to these directors, then the same will have to be disclosed separately, as you have in point B, that is loans and advances to related parties. It can come under this with each loan having a separate line item. Now coming to non-current investments. Now, non-current investments are broadly classified into investment property, equity, mutual funds, debentures, partnership firms. In case of non-current investments, for division 1 especially, if you are not recording them at cost, then you are supposed to mention the basis on which it has been recorded and the reasons, like why it is not recorded at cost. In case of India's compliant companies, we of course have FVTPL, FVOC, and amortized cost. So there the question of like disclosing for not recording at cost does not arise. Also, we got to mention the market value of the shares or of the securities that we are holding, and whether the investments are only for the quoted investments. And of course, we got to mention whether the investments that we have made are quoted or unquoted. Then any provision that you have made for diminution in value of the investments also needs to be disclosed under the head of non-current investments. Now for current investments, we have similar disclosure requirements, except that in current investments, in case of division 1 entities, we are having, we got to disclose the investments at cost or NRV. So that is the point of difference here. Otherwise, the disclosure requirements for current investments and non-current investments remains same. Okay, now coming to cash and cash equivalents. So cash and cash equivalents, as I mentioned earlier as well, that only the liquid assets are to be mentioned here, and no other asset is allowed to be considered as a cash and cash equivalent. Normally, as per our AS, we consider that any asset which is any cash or bank balance which is expected to be realized within 3 months can be considered as cash and cash equivalent. Now, the 3 months are to be considered not from the date of balance sheet, but these 3 months are to be considered from the date. All right. So we were discussing cash and cash equivalents. Normally, we have cash, then balances with bank, checks, drafts on hand, and others. And if there are any balances other than these, you got to specify what balances those are. Now, there are certain balances which are in your bank accounts, but you cannot access them. For example, unpaid dividend account, then you might have some dormant accounts which you are unable to access. Then these cannot form a part of cash and cash equivalents, as these are not liquid. You cannot be using them. So that will fall under other bank balances, that is other than cash and cash equivalent. Also, if you are having any accounts against which you have received any working capital, that is that basically means that they are under charge, so you cannot be utilizing them. Therefore, even they will not fall under cash and cash equivalent. Also, if you are having any restrictions for transfer of the balances, the same cannot fall under CCE. Then the bank deposits, which are having maturity of more than 3 months but less than 12 months, now they will come under current assets only, but they will appear in other bank balances. Now, if we look at division 1, we have cash and cash equivalents written on face. And if we look at division 2, we have cash and bank balances written on face of the balance sheet. So for division 1, there's an issue wherein we have such balances mentioned in point 2, 3, 4, and 5 on the screen. For this reason, in guidance note provided by MCA, they have mentioned that even for division 1, we can be changing the heading cash and cash equivalents to cash and bank balances. Now we are having certain disclosure requirements required by Schedule 3. So first, rounding off was not mandatory for division 1, that is IGAP. Earlier it was mandatory only for Ind AS compliant entities, but now rounding off has been made mandatory for both. Also earlier, the heading was tangible and intangible assets, which has now become PPE and intangible assets, with further classification into PPE, intangibles, CWIP, and intangible assets under development. Earlier, current maturity of long-term borrowings was classified under other current liabilities, but now it has been classified under short-term borrowings, as we also saw while discussing short-term borrowings earlier. Now, security deposits was classified under long-term borrowings under IGAP and under loans as per Ind AS. Now, these security deposits are to be classified under other non-current assets in AS compliant balance sheets and under other financial assets under Ind AS compliant balance sheets. Also, earlier the total of a turnover and your other income was to be total revenue, which has now changed to total income. Going ahead with some additional disclosures which have come up in the last year. Earlier, aging schedule for trade receivables was not required, and it has been mandated from the last year. So we will be having less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3, and then more than 3. For trade receivables, we will also be having to classify it under trade receivables considered good and disputed. Sorry, considered good, doubtful, and then disputed, undisputed. Now, the guidance note does not mention anything about what is the definition of disputed trade receivables. So whether you can be considering a trade receivable as disputed only when there is some legal dispute, or even operational disputes are considered. So that is left up to the judgment. Now this aging is to be done from the due date of payment. Say you are having a period, you have given your debtors a credit period of 30 days. So you will have to start to count after 30 days. But in case that is not available, then you can be taking the date of transaction, that is the date of actual sale. Next, coming to aging schedule for trade payables. it is the aging is similar to trade receivables, except that in trade receivables you have less than 6 months bracket as well, but here you do not have the less than 6 months bracket. Now the requirement for disclosing MSME was there earlier. From this year, the different part is about the aging and disclosing disputed, undisputed. Even here, it is not clear about which balances are to be considered as disputed. On similar lines with trade receivables, even for trade payables, the aging will be from due date of payment or from the date of transaction if due date of payment is not available.
So what has happened through this aging disclosures? No, earlier in our audit procedure, it was standard procedure to obtain aging of trade receivable and trade payable from the management. Okay, and then to ask to inquire the management and to audit procedures if there were parties were outstanding for more than 1 year or say more than 6 months, why this payment are not being released or why we are not collecting those payments. And if some answer was not satisfactory, then we were advising them to make provision or make write-off of those parties. Now that our internal working paper is now published, you can consider like that way. It is now published in the financial statements. It is now public data. So the user is empowered now. So if it is a listed company, correct? So at that time, what will happen that any user can ask why what this many debtors are outstanding for more than 1 year. What the step company has taken. Anyone can ask in company's AGM, right? What the company is, why the company is not made provision. This can be asked to the company's auditor. So this is such kind of step. So now auditor as well as the management needs to be very careful. Okay, now if we come to trade payables, so now those who have handled income tax assessments, no, they must be aware that it was standard query. It is rather than now only, it is standard query to ask aging of trade payables from income tax officer ask these details. And if it is not, if parties are outstanding for more than say 1 year, 2 year or 3 year, then they used to send notices to those parties under section 133(6), or there was addition by default addition under section 41 of the Income Tax Act. So these details are public to shareholders also and to income tax officers also. So when you trade payable parties are outstanding more than 3 years, then at the time of making income tax return, you have to consider whether this liability still exists or not exist. If it does not exist, then under section 41 of Income Tax Act, we may have to consider it as an income. So all those things we need to take care after this disclosure requirement. Earlier it was internal to the company management and auditors. Now it is public data.
Now going ahead with disclosures which pertain to the borrowings. Now if the borrowing has been taken from bank or financial institution and the same has not been utilized for the purpose for which it was taken, then the reasons for the same will have to be disclosed. Then if you're having borrowings from banks and FIs, then the quarterly statements that you are supposed to file with the banks, that is against the working capital requirements that you take from the banks. If these statements are not in agreement with the books of accounts, then ensure that these disclosures are also mentioned. That means that if there are any discrepancies, if it is not matching, then you will have to give details for the major discrepancies that were there. Now, if a company is declared as willful defaulter by banks, then even such details will have to be mentioned. Now, getting declared as a willful defaulter is a matter of fact. So you cannot be not deciding, you cannot be checking their financials for that. The banks normally publish a list of willful defaulters from where you can be checking this. Now, if there are any charges filed with ROC, if there are any assets under charge and you have created the charge which is filed with ROC, or if you have filed satisfaction of charge with ROC, In that case, only if there are delays in filing such charge, you got to be mentioning it in your financials. Now, it does not mention modification of charge, but in certain cases, even the modification includes creation of charge. For example, we were having certain assets under charge. Now we want additional loan. Therefore, we have added a few more assets to it. So for ROC, it is only modification, but in substance, you see that it is a creation of charge. So we are of the opinion that we should also be disclosing the details of such creation in case there are delays and the reasons for delays, of course. Now, disclosures related to the loans and advances that we are giving to the related parties. Now, this disclosure is required only in two cases. Say if the loan is repayable on demand and or if the terms of repayment are not mentioned. Only in these two cases it is required, else separately disclosing these details is not required. So you'll be required to mention the amount of loan outstanding and the proportion or the percentage of this loan to the entire loan. Now this will promote the companies to ensure that there are terms and conditions specified even when there is a transaction of loan between the related parties and not just outsiders.
So there is one question. Adesh Shah is asking, can balance in digital wallets be considered as a cash and cash equivalent? Okay, so AS3 defines cash equivalent that are short-term and highly liquid investment that are readily convertible into known amount of cash and which are subject to insignificant risk of change in values. So yes, if amount in wallet can be transferred to your bank account, which is generally the case, then I don't see any reason why this should not be considered as a cash equivalent. This can be considered as a cash equivalent.
Okay, as Vijay sir mentioned that we can be having those balances in cash and cash equivalent. Also, there are certain wallets through the cash through which can be utilized only for specific purposes. Now, if this is the case, then you cannot be adding it. Otherwise, as sir mentioned, you can be adding it to the cash and cash equivalence balance. Now, coming to disclosures regarding investments through intermediaries. Now, if a company, to go ahead with the disclosures first, let us just take an example. Say company A is giving loan to company B, and then the same loan is given by company B to company C. Now, it is basically that it is basically the loan which is given by company A to company C, which is routed through company B. Now, in this case, what disclosures are required in the company's A balance, in the financials of company A? So you will have to mention the date and amount, date and the amount of the investment or the loan which has been given by A to B, and the date and amount of the investment which was given by B to C. Then you will also have to give details of the security, if any, which is given by A to C, or if C has given any security to A. Also, if A is giving any guarantee on behalf of C. So it is not limited to loans or investments. It will also take into consideration if any guarantee has been given by A. Also, you need to ensure that FEMA, Companies Act, and Prevention of Money Laundering Act has also been complied with. So when C is receiving certain investments from A through B, even C will have to provide these disclosures in their balance sheet, in their financials, along with A disclosing that. Now coming to stock of companies, the companies which have been stock off under certain sections of Companies Act, if you are having any balances with such companies, Then the same needs to be given in the format on screen. That is, first of all, name of the company, then the nature of transaction that you have with that company, the amount outstanding, and see, in the second column where we have nature of transaction with stock of company, we can very well see the relation. But if the company has any relation other than anything mentioned in the column 2, you got to be disclosing that as well. Now, it does not only consist of the balances. If you have had any transactions during the year, even that will be considered for this disclosure. Also, if the company is having certain shareholders who are stock of companies, or if the company has invested or if the company is holding any shares in stock of companies, then that will also be have to disclose.
So Nidhi, there is one more question from CA Rao, Mr. Rao. So he is asking, mutual fund also can be transferred to credit to bank account. The same can also be classified as cash and cash equivalent. So mutual fund, if there are two conditions, that which is maturity of 90 days as we discussed, and whether cash and cash equivalent, it is must that amount is converted into known amount of equity. Okay, known amount of equity. So if it is equity mutual fund, then we do not know the known amount of equity. That price fluctuates on daily basis or say per minute basis. So it is, that condition is not satisfied. So in that case, equity mutual fund, definitely it is not cash and cash equivalent. There are certain categories of mutual fund like liquid funds. Okay, in which case underlying is money market instrument like government bonds or RBI bonds. So those liquid investment should be classified to cash and cash equivalents.
Going ahead with disclosures for CSR. Now, the companies to whom CSR is applicable, it is compulsory to give these disclosures, that is the amount of expenditure, if there was any shortfall during the year, and if there was any shortfall, then what was the reason for that shortfall. Then the nature of CSR activities. Now, this has to be a little elaborative. You cannot just be listing down. Then if you are doing your CSR activities through any of your related parties, for example, the company has opened a trust and the CSR activities have been carried out by the trust. So even that needs to be disclosed. Now, if there is any provision made, that means you have entered into a contract for CSR, but the funds have not been disposed of yet. So in that case also, you got to give details of the contract. Let us now move ahead to certain other disclosures. Now, if a company is having more than 2 layers of subsidiaries, then you got to mention that. Now, if a company is holding shares in a foreign subsidiary, then if the foreign subsidiary is having more than 2 layers below it, then we cannot be saying that it is a non-compliance, that this falls under exception. And then in case of amalgamation, demerger or merger, that is scheme of arrangement which is approved, if the AS or the scheme which is approved by the authority is not followed, then the same needs to be disclosed. Then any unrecorded transaction which have been surrendered to the income tax authorities, you got to give details of the same and also ensure that these transactions are recorded in the books in the appropriate manner. Then any investment in cryptocurrency or virtual currency, you got to give the details. This includes the transactions as well as the balances at end of the year. Now, these disclosures are only for Ind AS compliant companies. That is, lease liabilities will be grouped under financial liabilities. Earlier, it was under borrowings. And the statement of changes in equity will have to be given for 2 years. That is the current year and the previous year. Earlier, it was mandatory only for the current year. Coming to financial ratios, from last year, we are supposed to give the financial ratios as well. And if there is a variance of more than 25% or more, as compared to the last year. So you will be taking last year as base. Then you got to giving the reasons for the same. Now, reasons cannot be the ones which are quite visible from the financials. That is, current ratio has increased because our liability has increased. No, you got to be giving the operational reason for the same. Then in certain ratios, for example, we have trade payables turnover ratio. The ratios that we have learned that for trade payables, we will be having purchases in the numerator and the denominator would have trade payables. But in my opinion, this is not quite comparable, as the trade payable also includes balances of certain other expenses that the company has had. It is not only the parties which pertain to purchases. So we got to ensure that along with purchases, we also add the expenses which are having balances in trade payables. Now, return on capital employed, as mentioned in the guidance note, it specifies closing capital. But if you all see, the return that we are earning on the capital is not earned on the closing capital. We earn it on the opening and the capital that keeps maybe we generated through profits or it is added during the year. So in our opinion, it has to be average and not the closing capital. Then coming to return on investments. For return on investments, the formula which is mentioned in the amendment or the guidance note, it mentions market values. Since the companies which are following AS do not record their investments at market value, then for that reason, we got to ensure that we do not directly pick up the figures from the financials that are there, but make the numerator and denominator apt for this ratio. For Ind AS compliant companies, this issue might not arise because we have investments at FVTPL and FVOCI. For your reference, we have attached Schedule 3 amendment, a notification, the guidance note, and the actual Schedule 3, like for both Division 1 and Division 2. So once you all have the presentation, you all can refer to it. Okay. So now after understanding Schedule 3, let us come to CARO 2020. Now CARO 2020 is has come after CARO 2016 that we had earlier. There are certain clauses that have been added to CARO 2020 which were earlier not required. Then it was notified on 25th Feb 20 by MCA. Now, to which companies is CARO applicable? So the CARO statement does not mention to which it is to which companies it is applicable, but it mentions the exceptions. So the exceptions are banking companies, insurance companies, Section 8 companies, OPC, small company. Now you have to be careful in case of small companies, as the limits have changed. So now it is 4 and 40 instead of 2 and 20 earlier for paid up share capital and turnover respectively. Next, we have the private companies. Now, these private companies will be, for these private companies, CARO will not be applicable only if certain conditions are fulfilled. First, it should not be a holding or subsidiary of a public company. Then, the paid up share capital along with reserves and surplus should not exceed 1 crore. That means it has to be less than or equal to 1 crore. Even the total borrowings from banks and financial institutions at any point of time during the year. So you do not just have to check that whether as on balance sheet date it is less than or equal to 1 crore. Any point of time throughout the year, if it has exceeded 1 crore, then CARO will be applicable. Then the total revenue should not exceed 10 crores. Now we have a question for you, which is there on the screen, that if a company is a small company with turnover of 15 crores, then will CARO be applicable to that company? Okay, so as most of you have answered that it will not be applicable, the reason being that if a company is already a small company, then the exception in case of private company need not be checked. Once it has come under the exception for small company, the CARO is not going to be applicable. Now to go ahead with non-applicability. See, CARO 2020 is not applicable to consolidated financial statements, except the last clause, that is clause 21, will be applicable for consolidated financial statements. The remaining 20 clauses are not applicable. Now, what do we have in clause 21? It is basically if there are any qualifications in the audit reports of the components, or in audit reports of the associate or JVs which are being considered for consolidation, then the details of the companies along with the qualification will have to be mentioned in clause 21. Now, let us refer CARO directly from the for the bare notification. So the applicability that we have gone through earlier is mentioned here, and then the clauses start from the third point. Now the first clause pertains to the PPE and intangible assets. So 1A requires us to check whether the company is maintaining proper records of the PPE and PPE, and similar records are also to be maintained for intangible assets. Now these records are supposed to mention whether records are supposed to give disclosures regarding the location of the asset. The assets are expected to be numbered, so it's not that the asset IDs are only mentioned in the FAR. The asset ID should also be mentioned on the particular asset wherever possible. I understand that there would be certain assets wherein we won't be able to label them as such. Now, physical verification by the management has to be carried out at reasonable intervals. Now, how would you verify this? You can ask for a copy of physical verification report that was there, and then you can check whether the discrepancies in the physical verification and the actual records have been taken care of. In what manner were they taken care of? Was it appropriate to be doing so? Then, as we discussed even earlier, that if the title deeds of the immovable properties are not in name of the company, the disclosures that we had discussed for Schedule 3, even for CARO 2020, it remains the same. Also, the disclosure relating to revaluation of the property, if it is more than 10%, even that remains the same. Then we have a disclosure for Benami transactions again in CARO. Now, coming to the second clause, which pertains to the physical verification of inventory. Now, for both, for physical verification of inventory and for physical verification of assets that we saw in the first clause, the term reasonable interval is not specified anywhere in Schedule 3 or even in the guidance note. So, and reasonable interval is based on judgment. Now, for the inventories, when the physical verification was carried out, you got to ensure that you take from management the reports of physical verification. Then if there were any discrepancies, were they looked into correctly? Then the procedure that the management has followed for physical verification, was that procedure right? Do they have some standard procedure maintained that they refer to every time they physically verify the inventory? Then, if the discrepancies during the physical verification are more than 10%, then you got to be reporting that in CARO. Now, coming to clause 3. So clause 3 is applicable only if the events specified have happened during the year. Okay, so if you have made any investment or provided any guarantee, given out loans, whether they are secured or unsecured, to any LLP or any other party. So they did mention LLP earlier and to other companies, but this clause applies if the loans or investments have been given to any party. And this will apply only if these transactions have happened during the year. So if the transactions have not happened during the year, if it had already happened in the last year and you've got some balance in the current year, still this clause is not going to be applicable. So the okay, so we just skipped a part in clause 2, that was working capital requirements. So I will come back to clause 3 again once we are done with it. So if the company has taken any working capital loan from bank or financial institution which exceeds 5 crores, so the disclosure that you saw for Schedule 3 is irrespective of the amount that you have taken. Here it is if it is beyond 5 crores and it is a secured loan. So if there are any discrepancies, the details of the same will have to be provided in CARO. Now, how are we supposed to check for discrepancies? We can first obtain the sanction letter. Then we can check whether the QIS, that is quarterly information statement that you file with the banks, or just the stock statement or stock and debtor statement that you file with the bank, you can obtain it from the company and check whether they are in line with the sanction letter, and then whether the same is also tallying with your financials. And if there is any discrepancy, you got to be mentioning that. Now, talking in practical terms, the companies have to submit these reports by a particular date after the quarter has ended. So there is quite a possibility that there is a discrepancy in the actual books and the reports filed with the bank. So you will have to ensure that only the material transactions or only the material discrepancies are reported here, and not every little discrepancy is being mentioned. So it has to be meaningful reporting. Now we can jump to clause 3. So as we were discussing, that clause 3 will apply only if the investment guarantee or loans have been given in the current year, that is during the year. If not, then this will not apply. So clause 3 in the A part, it mentions that if any, now A part talks only about loans and guarantees. Okay, it does not talk about investments. So any loans or guarantees given, you will have to mention the balances outstanding at end of the year. Now, loans, guarantees, and securities. Now, the details of these are to be bifurcated in 2 parts. First is with the balances for subsidiaries, joint ventures, and associates, and the second part will mention the details for all the parties other than these 3. And in, next, if you have made
one important change is this, that earlier it was required that companies covered under section 189 of the Act. So this was in which director is interested. Now it does not mention if any loan is given, whether those parties are covered under section 189 or not. This disclosure is required.
Okay. Now coming to point B, it mentions that we got to check whether the terms of the guarantee, loan, or investments that we have made, whether that is prejudicial to the company's interest. Now, the examples for the same can be, you got to check whether the loan that is given is secured or unsecured, or if you have taken the security, is it only for namesake, or that security actually covers the major portion of the loan, or will you be able to realize money after disposing of that security? Then, of course, lower rate of interest is basic example. Then we also have unfavorable repayment terms. The repayment terms are such that it is prejudicial to the company's interest. So these things are, of course, there is some judgment involved here. And whenever you think that it is prejudicial, you got to report it in the CARO. Then.
So here so we need to check whether proper credit appraisal has been done before granting the loan, if that loan amount is material. So again, I said that this requirement was covered under section 189. Now it is for all the companies, okay, all the borrower. So for this, we need to check whether credit appraisal is there, whether proper documentation has been done or not. So this, we need to be very careful while auditing.
Okay. Now, we also need to check whether the repayments of these loans are as per the repayment structure or the repayment schedule that had been decided at inception. So how can you be doing it? You can obtain the repayment schedule. Then you can check the balances in your financials and match it with the repayment schedule. If there is any discrepancy, you can inquire with the management as to why is it not matching. And you also need to check whether they are regular in payments. That means there is no delay in repayment of these loans. Also, where the amount is overdue for more than 90 days, then you got to be taking required action. For example, you can hold any other payments that you have to be making to that party, or the legal measures that you have taken, or you can stop the supplies. These are the steps that can be taken. Only saying that we have filed a legal case is not enough in this case. Then the loans that you have given, now point E and point A are related to each other. That means they talk about the loans and loan guarantee and loans and guarantees. So if there is any loan which was to be repaid, but you have granted a fresh loan against it, or you have renewed the same loan, then the same needs to be mentioned in CARO 2020. Now, this concept is called as evergreening, that a loan was taken and since the party could not settle it, you are again giving loans further. Now, part A and part E is not applicable to the companies whose principal business is to give loans. But practically seeing, these are the companies who can be doing it more often than the companies who are not engaged in this business, that is giving fresh loans or renewing the loans again and again, and not receiving it for many years. Then in clause F, in point F of clause 3, we are having the loans and advances which are granted to the related parties. Now, this disclosure remains same as it was in Schedule 3. That means you will have to mention the amount outstanding at end of the year, and you will have to mention the proportion or the percentage of the loans which are outstanding to the total loan outstanding. That is a total along with the other parties other than the related parties. Next, we have the disclosures with respect of section 130, 185 and 186 of Companies Act. So you got to check whether these have been complied with. Now, section 185 and 186 talks about the 185 talks about loans provided to the directors of the company, of the holding company, or any relatives of the directors, partners of the directors, or the entities in which the director is interested. So how to be checking? So 185 is 185 says that you're not allowed to give them loans. So how can we check if any loans were given to these parties? First of all, you can take the listing of loans that the company has provided. Then for the entities in which directors are interested, you can be checking MBP1 form, in which directors give details of the entities in which they are interested. Also, the company is supposed to maintain a register in MBP4, in which the details of all the directors can be sought from. Then you can check the related part. You can check the related party transactions for this. And if there are any transactions which have taken place which are getting covered under the exceptions. So 185 says that you cannot be giving loans. But if there are certain exceptions under which your transactions have fallen, then ensure that you take proper evidence supporting that yes, it does fall under the exception, and which is why we are not reporting it here. And then section 186 mentions that you cannot be making investments through more than 2 layers. Now, the disclosure for this is required in Schedule 3 as well as in CARO 2020. Also for section 185, say company A is giving loan to entity B, and then B is giving it to C. Now the loan now this loan, if was given by A to C directly, it would have fallen under section 185 non-compliance. Then even the transaction between A, B and C will fall under the non-compliance. So you cannot be routing it through some other entity. And if the company is having investment through more than 2 layers, the same also needs to be disclosed in CARO, which will fall under section 186 non-compliance. Coming to clause 5 of this. Now, if the company has accepted any deposits, then we need to ensure that the company has complied with RBI guidelines. Also, there are there are certain deposits which are deemed deposits. So maybe in the financials, they are not shown directly. So how to be identifying all of this? You can check DPT3. DPT3 form is the list of deposits that the company has, and it has to file it with the ROC every year within some stipulated time limit. Coming to clause 6, whether the company has maintained cost records. Now, not all companies are required to maintain cost records. There are certain limits. The limit is 35 crores. So if a company is having turnover of more than 35 crores, then cost records might be applicable, because not each and every product requires cost records to be maintained. There is a list of products and services for which cost records are to be maintained, which is specified in section 148. So if the cost records are required, you got to be checking whether they are maintained. If cost audit, now this clause does not specifically mention about cost audit, but if cost audit is mandated, then you can be checking the cost, you can be seeking the cost audit report from the management, from where you can get more clear idea about it. And if they are not complied with, you got to be reporting it in CARO 2020 clause 6. Now coming to the statutory dues clause, that is our clause 7. You got to be mentioning if the undisputed dues are paid to the government within time. Now this talks about only the statutory dues which are to be paid on regular basis. If there is any statutory due which needs to be paid on happening or non-happening of an event, then such statutory dues are not covered under clause 7. Any statutory dues which are disputed, okay, you got to be giving details of the same. Also for the undisputed statutory dues, as on balance sheet date, if there are any dues which are outstanding for more than 6 months, as on the balance sheet date, you got to be giving the details. For the other undisputed statutory dues, which have been paid before the balance sheet date, but there was a delay during the year, then you will have to give the details of the same as well. Now, if there were only 1 or 2 delays during the year, a lot of companies, CARO report says that the company was generally regular. Now, the term generally regular cannot be used. So this was one of the FRRB observations, and the suggested way of reporting it can be that there were some instances of delay during the year. Otherwise, the company was regular. So this is a better way of reporting. Coming to the disputed dues, just the fact that no, we are not ready to accept, or we have not acknowledged that this is a stat due that we ought to be paying, is not sufficient. Okay, you actually got to go and appeal against that dues, which is when you can be calling it as disputed. So for this, what details can be given? You will have to give the name of statute under which it is pending, then the nature of dues, say it is a tax or it is some other due, then the amount which is involved, then the year to which it pertains, then the due date which has been given to your company for paying those dues. Now, coming to our clause 8, that is transactions which have not been transactions which were not recorded in the books but have been surrendered to income tax authority. Now, this was also one of the Schedule 3 disclosure requirements. Now, the guidance note emphasizes on the word surrendered. That means it says that if the company has acknowledged that yes, we do actually have some undisclosed income, which is only when this clause will apply. If the company has not surrendered it, then it will not apply. Now, clause 9 talks about default in repayments, or if you are declared as a willful defaulter, and a few other points which will come ahead. Now, if the company has defaulted in repayment of the loan, then you got to give the details as mentioned in this format that they've given, that the amount which was not repaid, and whether it is the principal amount which is not repaid, or it is only the interest, or is it both. Now, how to check this? You can, as we were supposed to check for the loans which were given to our related parties, we can also be checking in this case where we have received the loans. We can take the sanction letter. We can also seek the repayment schedule from the management, from where we will get the details of default. Also, you can ask for external confirmation from the bank. Now, if you have submitted an application for restructuring your loan, now that does not imply that the default has not happened. You have defaulted and you have applied for restructuring. So even in that case, the auditor will have to mention that there was a default. Also, if the application for restructuring has been accepted by the bank, then such fact needs to be mentioned in this clause, that the company had applied for restructuring of the loan and which has been accepted by the bank. Now, whether the company has been declared as willful defaulter, again, now this is a matter of fact, and you can check the bank's website, from banks or financial institutions website from whom the company has sought the loan. Then checking whether the loan has been applied for the purpose for which it was borrowed. Now the sanction.
So one important point here is earlier this default requirement, it was only for banks and financial institutions. Now it is not specifically mentioned as bank and financial institutions. So it is for all the loans, even if it is loan from say third party or related party. Then if you have defaulted, then this needs to be mentioned in CARO, not only banks and financial institutions. Okay, so scope of verification and audit has increased on account of this reporting.
Now going ahead with point C of clause 9, we got to be checking whether the loan was applied for the purpose for which it was taken. Now the sanction letter usually mentions the purpose of the loan. You can check from the financials as well whether the asset which let us say they had applied for a loan for purchasing an asset, then whether that asset has already actually been purchased by them or not. Also, sometimes the loan is dispersed towards end of the year, like say around in the month of March. So it is not possible for the company to quickly apply it for the purpose. So in these cases, after 31st March, you got to be checking whether the loan was actually applied for that purpose. And you can mention in CARO that since the loan was dispersed at a fag end of the year, fag end means the open end, the company could not utilize it before the balance sheet date, but subsequently the loan was applied for the mentioned purpose. Then clause D specifies we got to specify whether the short-term loans have been applied for long-term purpose. Now even this is factual, and you can be analyzing their financials to be checking it. Also, in certain cases, for point C, I'm saying this. In certain cases, the company parks the funds received as loan for some time to reduce their interest on working capital, because as of that date, it is not required for them to be utilizing it. So that cannot be constituted as they are not utilizing it for the purpose for which it was borrowed. For some time, if you are investing it elsewhere, because there is time for you to invest it in the asset that you are actually taken it for, is completely all right. Now, if the company has taken funds, I'm coming to point E now. If the company has taken funds to fulfill obligations of its subsidiaries, associates, or JVs, then these details are also to be mentioned. Also, this can be checked from the sanction letter, and also you can go through the financials of these components to find out if there is any such transaction. Next, if the company has taken a loan against securities of its subsidiaries or JV or associate, then again that fact needs to be mentioned. Now these can be also checked from the financial statements of the subsidiaries, because even they will be having a clause for borrowings, for only all the assets that are under charge, we got to be mentioning for what reason is this asset under charge. So this can be easily verified from the financial statements of the subsidiaries or JVs.
So the checking all the sanction letters sanction letter of all the borrowings and making their summary is very important. Okay, and that someone from the team should read sanction letter thoroughly, make their summary, what are the security, who are the guarantee providers, whether they are director or not. This tabulation in Excel file will be very helpful. And regarding point D, whether fund raised on short-term basis have been utilized for long-term purpose. This is also very important, and this some working should be there to justify our comment in audit report. Correct? Something should be there. So it can be from direct nexus, whether the amount received from loan statement where it has been utilized, or we can do balance sheet analysis. Okay, this is much is the delta in loan account, and this much is the delta in my current assets and current liability account. So whether can you say whether this loan was applied for this purpose or not? Some conclusion should be drawn from working paper here for clause D. If you have short-term borrowing, this analysis is very helpful.
Thank you, sir. Now, coming to clause 10, where A part, where the company has raised any loans to IPO. Now,
Money, not loans. But how much?
Raised any money through IPO.
Yes.
So now we got to be checking whether the funds which were raised have been applied for the purpose for which they were sought. Now, this is normally mentioned in the initial public offer document that we have, or you have the prospectus. So whether the utilization of the fund is in line with the document that was actually provided before raising the funds. If there was any delay, then even the delay needs to be specified. And if there was a default, then you will be reporting it in the CARO. Then for private placement, which is in part B, section 42 of Companies Act lists down the compliances for private placement, and section 62. Section 62 is are the provisions for further issue of equity. Now, private placement, you can check points like whether maximum 50 people can only be contributing to it, except for qualified institutional buyers. Then you got to be ensuring that the funds that were raised in point A and B, if they were in excess of what was required, if there was over subscription in case of A, and in case of B, if you got to be returning the funds, then was that done in the specified time limit? If not, then even that will be considered as non-compliance and will have to be reported here. Now, coming to clause 9, whether any fraud by the company was committed. Now, this is a
notice or reported, not committed. So this.
So if any fraud was noticed, then the same needs to be disclosed in CARO 2020. Now, form ADT 4, which is mentioned in point B of clause 9, sorry, clause 11. Now, ADT 4 needs to be filed under subsection 12 of section 143 of Companies Act, where the amount involved in fraud is 1 crore or more. So this fraud needs to be reported to MCA. Now, if during the year any such fraud was reported to MCA, you got to be reporting it in CARO. Now, section 143.12 does not say that only the statutory auditor has to be reporting it. It can be the other auditor or the other relevant person also reporting it to MCA. So, CARO 2020 is not limited to only the statutory auditor reporting it to MCA. Even if it was reported by anyone else, you still got to be mentioning it in CARO 2020. Then whether any whistleblower complaints have been received. Now, for whistleblower complaints, first of all, you need to check whether the company has a mechanism for it.
It is called vigilance mechanism. So it is mandatory. It is mandatory for certain kind of companies.
Okay, and so the mechanism for whistleblower complaints, as mentioned by Vijay sir, is going to be is mandatory for certain companies. So you got to be checking with that. Also, such complaints can be discussed in the meetings of board. So while going through the minutes, you can get to know about such complaints. Then clause 12 relates to Nidhi company, where the net owned funds
about Nidhi company. Yeah.
Okay. So you got to be ensuring that the ratio of net owned funds to deposits is 1:20. Then at least 10% is not 10% of the deposits are not under any charge. And if there is any default in repayment or payment of interest, then you have to disclose it in this clause, that is clause 12. Then in relation to transactions with related parties, now we already have certain disclosures which are mandatory in Schedule 3. Then also when it comes to borrowings, there are certain disclosures. Now these related party transactions have to be approved by the management, have to be approved by the audit committee. So section 177 mentions this, that related party transactions will have to be approved. Now, how can you be checking this? The audit committee meetings minutes can be checked to identify these approvals and the related party transactions that are there in the books. So you can try to match whether all the transactions that you are seeing in the financials have corresponding approvals in the minutes also. Then section 188 mentions that these transactions have to be done at arm's length price. So either of the section not complied with, you will have to report it in CARO 2020. Now, coming to clause 14, that is internal audit system. So part A mentions that you got to check whether the internal audit system which is there, is it appropriate for that company? Have they ensured that all the systems required are in place, and are they commensurate with the size and nature of the business? So you cannot just have some little checks when your business is quite vast. Also, whether the report of internal auditors were considered. Now, internal audit is not applicable to all the companies, and to the companies to whom it is not applicable, they can be voluntarily appointing an internal auditor. Now, we got to be checking whether the internal auditor appointed is having the competence required, because internal auditors need not be chartered accountants. They can be cost accountants, as well as they can be some employee or some other party as well. So ensuring that the person who is conducting internal audit is competent enough to be doing it is also a part. And the reports that you get from the internal auditor, you can be checking the scope, the procedures that were followed, because the internal audit reports normally specify the procedures that were being followed for conducting the internal audit. So all these things can be taken care of. Then we have non-cash transactions with directors in clause 15, and whether the same was in compliance with section 192. Now, section 192 does not consider each and every non-cash transaction. It specifies that the non-cash transactions in terms of assets. That means if any asset was acquired by the company from the director for a consideration other than cash, or vice versa. So for this, only these two transactions are considered. Transactions like giving rent-free accommodation to the directors, etc., is not considered in clause 15. And the second part in this, we need to first check whether there were any transactions, and second part is whether they were appropriate. So the second part will arise only if there were some transactions. How it can be identified is you can do ledger scrutiny that we normally do for every client that we do audit for. Next, we have clause 16. Now, clause 16 talks about NBFCs. Now, we got to check whether the companies which are required to register, to get registered under section 45(1)(a) of RBI, whether they have registered. If not, then you need to report it in A. Now, the NBFCs, now if the company is not an NBFC, like not registered as an NBFC, but they are carrying out the activities of NBFC, then the same needs to be mentioned. Now, if a company is having more than 50% of the income from the financial assets, or they are asset based, is having more than 50% of the assets of which are financial in nature, then it will be considered that the company is carrying out NBFC activities, and the company will have to seek registration. So if the same is not complied with, you got to be reporting it in 16B. Then the 16. Then
So whether company was required to be registered, that you need to mention under 16.
now the companies which are core investment companies, for example, Tata Sons. Now core investment companies are basically the companies with at least 90% of their assets comprise of the equity shares, preference shares, bonds, debentures of other companies. So they are into investments. Now, whether these companies are complying with the RBI regulation and the criteria that RBI mentions for them, and whether they have sought registration, and if registration was not required, or if they are falling under some exemptions from registration, then you will have to ensure that you seek supportings for the same. Now, you also need to disclose if there is more than one CIC in the group of companies, in the group to which the company you are auditing belongs. Then, if the company has incurred any cash losses during the year, then that needs to be disclosed under clause 17. Now, cash losses can be calculated by taking base of your profit or loss, and then making all the non-cash adjustments that you have. For example, depreciation, you have impairment, fair value changes, you have revaluations, then unrealized foreign exchange gain or loss. Now, these are the examples of non-cash items that you will have to adjust. CARO 2020 has not given any definition for cash losses, but you can be adjusting these items and then reporting appropriately. Now, if there was any resignation during the year by any of the stat auditors, then that needs to be disclosed in that needs to be reported in clause 18. And also, if there were any objections or concerns raised by the previous stat auditor who has resigned during the year, you will have to report the same. Now, clause 19. Now, this clause is expecting you to report on whether the company is going to be a going concern. So there is no material uncertainty over going concern assumption. Now, it mentions that it has to be based on it has to be based on knowledge of board of directors and management's plan. Now, this is not the only aspect that you got to be looking at. You can be analyzing the financials as well.
That is fine, that you can cover. So the CARO requires auditor to consider various factors like financial ratios, aging, expected date of realization of financial asset, payment of financial liability, and one other thing it want us to check is other information accompanying the financial statements, and the auditor's knowledge of board of director and management plans. So here management representation becomes very important. Okay, how auditor have access to all the data, all the past data, but auditor may not have access to the future plans of the company. So this require, if going concern question arises, then auditor should be inquiring about future plans of the company from BOD and from top management, that how they will mitigate these going concern issues. So there are various factors which we should consider as a going concern. It is not that if your net worth is positive or if you are making profits, you will be going concern. There are recent examples in public domain, right? Because of which certain companies has become not going concern. Some reputed bank in USA, it has become non-going concern despite making profits due to various reasons, which Nidhi can explain in detail.
All right, I'm sorry, I was on mute. Also, as sir mentioned that we will have to obtain certain data from the management, and even otherwise we will be able to check these things on from analysis. For example, we can be checking the ratios of the company. Then we can take into consideration the contingent liabilities that the company has. Also, as sir mentioned, that it is not necessary that since the company is doing well, the company is having good asset base to fulfill the liabilities, it is not necessary that the company will be able to survive uh, in the coming year. For example, the recent case of Silicon Valley Bank. Now, this bank had purchased bonds when the interest rates were quite low. Now, you all know that interest rates and the bonds price are inversely related. So when the interest rates were raised by the central bank of the country, the bond rates fell down. So which is why this company was in terrible trouble. So there are a lot of things that will need to be taken into consideration while reporting under clause 19, because it is one of the significant things that need to be looked into. Next, we have reporting related to CSR. Now, we need to, as per clause 20A part, we need to be checking whether the company has complied with subsection 5 of 135. Now, what does section 5 of 135 say? First of all, it mentions the quantum of CSR that you should be doing. It mentions the limit. That is 2% of average net profits of the company for last 3 years. Now, this has to be the amount that you are supposed to spend on CSR. Now, if the company is unable to spend that amount during the specified year, then the unspent balance needs to be transferred to the fund which is specified in Schedule 7. Now, Schedule 7 mentions the activities for which CSR, activities in which CSR can be done, and certain funds also where the unspent amount can be transferred. So now this unspent amount has to be transferred within 6 months from the end of financial year. So you need to check whether the same has been transferred. If not, report it in 20A. Now 20B B gives a mention of section 135(6). Now, what is the difference between the unspent amount in section 135(5) and 135(6)? 135(6) mentions that any amount which is unspent, which relates to the ongoing projects. And section 135(5) mentions the unspent amount which is not related to ongoing projects. So for the amounts which do not relate to ongoing projects, you got to transfer it within 6 months. The amounts which pertain to ongoing projects, you got to transfer it within 30 days from the end of financial year. And if the same has not been complied with, you will have to report it in CARO 20. And clause 21, we have discussed with non-applicability of CARO 2020. Now, I rest my session here, and we are open for any questions that you have.
So there were questions, there were many questions, and Nidhi, I have answered them when the session was online. Okay.
Yeah, I think most of the questions in Q&A session we have already answered them, and in chat session also Vijay sir has answered. Any more questions from participants? I think there are no questions. So please, I have put the link to a WhatsApp group and Google form. You can join you can submit your feedback and join the WhatsApp group. Can I get that?
So there is one
Yes.
question from Adesh, right?
Yeah.
Adesh, about return on investment. Okay, so he has asked this question earlier, and I said I will explain at the end of the session. Yes, Nidhi, you can explain.
Yes, Okay, so I will just share the screen so that you can actually see the formula which is given under division 1 guidance note. The same formula is also there in division 2. Okay, now this is the return on investment formula which was given in guidance note. Now the doubt that you must be having was must be regarding the market value thing that I mentioned. Now this formula mentions that you will have to consider the market value in the numerator as well as the denominator. Now when you are recording the investments in AS compliant financials, you record them at the cost. So that is why the denominator, which is having the investment, will not will not be readily available. Of course, you have the market value, but against that, when we are recording the income, if there is any appreciation in value of the investments that you are having, you do not record it as income in your financials in AS compliant companies. So even the numerator is not available. So you either got to be writing a note that the basis on which you have arrived at on this ratio, or you can make the necessary adjustments to include the impact of market value. I hope this clears out. If you have any further doubts, you can ask them.
You can. So next question is from Nilesh. He said regarding rounding off, Schedule 3 is a minimum requirement. So can we continue to show full value instead of rounded off figures? So what is happening, Nilesh, is now the Schedule 3 says, even IGAP Schedule 3 says you should round off. So it is, in a way, it is mandatory. But most important thing is relevance. Whenever you are preparing financial statement, it is for the users, right? Users understanding purpose. So, am I audible, Dhyanesh?
Yes, you're audible.
Yeah, so I'm audible. Okay, so relevance is very important factor. So suppose if your financial statement, the company is not into operations and your balance sheet is of 2-3 lakhs of rupees or few lakhs of less than 1 crore balance sheet total is there, then while rounding off, you may not be preparing relevant picture of the financial statements. So in that case, what you can do that for account of better presentation, you have not rounded off the amount in the financial statement. That note you can write in the notes to account. That note you can disclose. Otherwise, if the amounts are bigger, then it makes sense to round off, right? So if rather you are counting commas and yes, what is the turnover? Yes, 1500 crore is the turnover. So it is better to round off and say the amount is in rupees in crore or rupees in lakh. So it is better. So when we say India's population, we do not say 142 crore, 22 lakh, this. We say 142 crore because it is easier. It is more relevant data, right? So that relevance should not be, it should always kept in mind while discussing this requirement of rounding off or not rounding off.